Thanks for joining us for the Future of Finance. We're beginning our breakout sessions now. My name is Chuck Grosvenor, and I'm a member of the Society's Programs Committee, and I am very happy to be here to introduce our speaker, Blake Melton. Blake is a senior wealth strategist with Synovus in Columbus. Thanks for coming to Atlanta. He has a BA in economics from the University of Colorado at Boulder, which he wanted me to make sure you knew came before the change in the laws in Colorado. He has a law degree from the University of Georgia Law School, and because that is just not enough, he also has his LLM in taxation from the University of Alabama School of Law. Blake's kind of an overachiever. He's a fellow with the American College of Trust and Estate Council. And because his day job isn't enough, he's also the chairperson of the fiduciary law section of the State Bar of Georgia and serves on the code revision and legislative committees. Those are the folks who a couple of years ago got some changes made to make power of attorneys here in Georgia a lot simpler. I thank you guys for that because I use that for my daughter when she went over to Europe. Very handy. It's nice when you just have to go to UPS and get somebody to, notarize your signature. For fun, Blake also serves on the boards of Bicycle Columbus, Midtown Incorporated, and Trees Columbus, and he is treasurer of the Chattahoochee Valley Area Chapter of the Southern Off-Road Bicycle Association, which has an acronym even longer than ours. For fun, despite all that, he still has time for a family. He met his wife in law school, and they both have 2 daughters. We're very happy to just get a slice of all that time. And without further ado, Blake Melton.
Thank you all for being here. Can everybody hear me? All right. I'm impressed by how many people there are. I mean, we have investment folks in my shop, and I was convinced this was going to be a small crowd. I got here and they told me they were dividing off the rooms and everything, and I was imagining the door almost closing and y'all trying to squeeze through to avoid the estate tax talk. But what I'm going to do, I appreciate you entrusting me with an hour of your time. We're going to try to do it useful knowledge, mildly engaging fashion, and I'm going to try really hard to remember that I'm not talking to a room full of estate planning attorneys. So if I let some acronym slip or I'm going too fast with a certain concept and you look at folks at the table and they're like this, please raise your hand. Feel free to interrupt me and ask a question or ask for clarification. What we're going to talk about, the 2017 Tax Act is still the big news, but this is a 2019 talk about recent developments in the future. So we're going to touch on some of that a little bit, but I've tried to find other topics rather than the 2017 Tax Act. I'm convinced that 12 presentations on the 2017 Tax Act have been given in this room, and another 12 in the room next door. It has been talked about. But there are other things going on, and we're going to try to touch on those. So what we're going to do is probably cover topics 1 through 3, and I left these 2017 Tax Act slides in here. If anybody just can't get enough, I think they're going to be made available to you after the seminar. So transfer tax, estate, gift, generation skipping tax. Most of you probably know the exclusion amount has been doubled. The exclusion amount is the amount you can give or leave without paying any transfer tax. That has gone over the past 20 years from under $1 million to now $22 million, roughly. So if you're a married couple and you have less than $22 million, today you do not have an estate tax issue, which means that the vast majority of the country and the vast majority of your clients, most likely, do not have an estate tax issue. And so this has continued and accelerated this trend of income tax planning and stepped up basis planning becoming more important for most folks than estate planning. With y'all, I'm going to skip ahead and give you the concrete example, and because y'all are a quantitative crowd, and then we'll come back and I can pontificate about the future of the estate tax. So for this example, assume there's a flat transfer tax rate of 40%, which is actually the case. We'll use a round exclusion amount, that tax-free amount of $22 million, and a flat capital gain tax of 20%. So assume the Smiths, our hypothetical client, they've got a $24 million estate. and we're going to assume they've got some low basis coke. So here's how engaging in planning as the Smiths can actually hurt you. So the Smiths give $4 million of coke to a trust for the kids because they have an estate tax right now, so they're trying to do planning. That coke's got a $1 million basis. So the Smiths, they go on some nice vacations, they live a long time, they have end-of-life care, and they spend this down, the market doesn't do well, they die with $8 million. Well, if the Smiths had kept that $4 million, they'd only have $22 million. And $22 million's the tax-free amount, so they wouldn't pay estate tax. And if they died with that $4 million of coke, the basis gets stepped up, which means that they don't have capital gains tax. So because they gave away that $4 million and then died without a taxable estate, they're $600,000 worse off. Their kids inherit a $600,000 capital gains tax liability. Whereas if they'd held on to that coke stock and died with it, their kids get coke stock that has a basis of 100 cents on the dollar. So you want to avoid that. You also want to avoid the sort of the other side of it. You don't engage in estate planning for the Smiths. The Smiths, they don't spend as much, they don't have as much end-of-life care, they die with $26 million. Well, now you have a $4 million above the $22 million tax-free amount. So now you're going to trigger the estate tax of 40%. So they owe $1.6 million in estate tax. But they did get the stepped-up basis, so they got rid of $600,000 of built-in capital gains. So now they're $1 million worse off. So that's why you have to be careful either making the gift or not making the gift. And so to back up, the prescribed actions are if you can look into the future and figure out whether or not you're going to die with a taxable estate, you're going to owe estate tax. If you're going to owe estate tax, the estate tax rate's 40%, capital gains rate is less than that, so you want to avoid the estate tax as a general matter. So you want to give assets away and do GRATs and CUPERTs and all the classic acronyms in planning. But if you're not going to die with a taxable estate, for tax purposes, you want to hold on to those assets, appreciated assets, and get the stepped up in basis. And the trick, obviously, is that nobody knows whether they're going to die with a taxable estate. That estate tax liability is a function of asset growth and income. And that's generally, I think, what y'all spend most of your days worrying about is that side of the equation. It's also an issue of spending. And clients a lot of times think that they can have a lot of control over spending. And they can. They can control what kind of cars they drive and wine they drink and vacations they go on. But you can't control how long you live. And you can't control what sort of end-of-life care you have. And then there's the variable of what's the tax law going to be at death. And as y'all may remember from 2011 and 2012, it bounces all around. We have very inconsistent tax policy, especially in this area of the law. So what's likely? We got $22 million right now. We have it through 2025. What's likely to happen? So I think I'd say as a general matter, having a $22 million exclusion amount so that someone with $20 million can die and not pay estate tax, but then you give stepped up basis to the person that didn't pay estate tax, that makes no sense from a policy standpoint. Why, just because you die, all your capital gains are wiped away? The traditional justification for that used to be that you just paid estate tax, so we don't want to hit you again. And this was back when the estate tax was $1 million or even under $1 million. So everybody in this room either has $1 million or has a realistic hope of having $1 million. Like everybody that was a successful professional used to at some point in their life had a net worth that was a taxable estate. So most people paid estate tax, so stepped up basis made sense. The other justification for stepped up basis was record keeping. Like, how did we know that we got this Coke stock from Granddaddy and who bought it in 19 whenever? And how do we know what the basis is? Well, as all of y'all know, we have these rules now that require the executor to give the form, and whenever y'all transfer assets, the basis is supposed to go with it and all this. So the traditional justifications for stepped up basis kind of don't hold water, especially below $22 million where you don't pay estate tax. So there are a number of potential outcomes. One is we go back to like a $3.5 million exclusion amount. If the Democrats retake Washington, I think that is very likely. Major candidates are already talking about whether they're talking about a state tax or whether it's Elizabeth Warren's wealth tax, which has a lot of problems in itself. But I mean, a state tax has never been this front and center in a presidential campaign before. And I think whereas a $10 million amount for a married couple didn't offend the Democrats that much because, you know, if you think about California and New York and housing prices, and I mean, people could live with, you know, that 7 or 10 million, but I think the Democrats think 22 million is obscene. And so I think you're going to see a lot of proposals to bring it back. The other thing that could happen is they could abandon the estate tax and focus on capital gains recognition at death. And this is what Canada and a lot of other countries do. So go, we don't have an estate tax, but when you die, it's a recognition event, and you're just going to pay your capital gains. You could go that way because the Democrats got completely out-messaged and out-PR'd on the estate tax. It's the death tax. The Democrats never successfully branded it like the Paris Hilton tax, right? All these people that will never owe estate tax somehow think it's grossly unfair. And it may be, but I mean, the Republicans won the messaging battle on that. So the Democrats could just abandon it. You go, know what, we're going to leave all that baggage behind, and we'll just go to this Canadian capital gains recognition system. And that's, some of that could happen in 2020, and then the Republicans could, it's just going to bounce all over the place, I think, for a while, given how far to the right and how far to the left our political parties have gone. The other thing that I think is coming is some economic and budget realities. I hesitate to talk monetary policy to this group, but it's, our deficit is higher than it's ever been. And we're not bringing it back down after 2008 like we have after past world wars and other wars that have driven it up. And it seems like to me at some point that becomes an issue. Our spending is not historically high. Our non-defense discretionary spending is really low. So when you look at the spending side of the budget equation, there's not a whole lot of give there. So then you got to start looking at the revenue side. So I think there's going to be increased pressure to bring revenue out of us, and out of our clients. And then again, the politics and income inequality and what you're seeing on the campaign trail, which all is to say, I don't think it's going to be permanent, and I think when it changes, it is going to come back south in a less taxpayer-friendly direction. So what do we do about all this? Well, first of all, we can figure out where we're not confused. Below 10 million, I think you can safely assume that if you die with less than $10 million, whether it's now or whether it's 10 or 15 years from now, you're not going to owe estate tax. I think that's a pretty good working hypothesis. I am not doing any estate planning personally. I don't think that most of us are ever going to get there. But for clients, below there, you're probably fine, focus on basis. Above 30 million-ish, you just carry on. Like, we've got a lot of $50 and $100 million clients. None of this matters to them. As long as we have an estate tax, as long as it's not completely abolished, that group of people is always going to owe it, right? Like, just however you state it, they're going to owe it. So I think you can continue planning. It's between 10 and 30 million where we don't know exactly what to do because we can't predict the future. So the takeaways for y'all, I think, are one is that flexibility is key. And if your clients are talking to estate planning attorneys and doing estate planning, they need to be talking. And I don't expect y'all to know what Clayton Q-tips are, even Formula General Powers, but there are strategies out there that preserve some flexibility and try to allow you to give assets away, but then maybe suck them back into the estate to get the stepped up basis. That discussion needs to be going on. I think more importantly, and it's not on the slide, it should be, is that why I'm saying 10-ish, 30-ish, is you've got to run asset projections on clients in Monte Carlo scenarios. If there's a 60-year-old client that's worth $30 million and they spend very conservatively, they're probably going to stay above $22 million. If you have somebody that's $22 million that's 50 years old that just sold a business and they're shopping for a beach house and a mountain house and a new Ferrari, like you go, well, they may solve the problem themselves, right? They may spin their way out of an estate tax liability. So some thought needs to, and projections need to be done about where are you in life, what's future income, what's spending, in 20 or 30 years, where are you likely to land? And then finally, I don't think we should be lulled in complacency. I mean, we've got some clients that maybe don't have a taxable estate, but they really want to get money to kids. And if you've got a business owner that's got 3 growing businesses and they spend pretty conservatively and they're under that amount, you can probably make a pretty good guess they're going to get over that amount. So, you may want to go ahead and start planning. It becomes very fact intensive. But I think y'all, and I do this some, even though I'm an attorney, this whole financial planning sort of projections and Monte Carlo analysis are hugely important to figure out where people are likely to land. So there's some things that have gone on in Georgia that are state law specific that I think are important for y'all to know about. And we passed a big set of amendments to our trust code that took effect July 1, 2018. A lot of those amendments are designed at increasing flexibility, and they were Georgia catching up with lots of surrounding states and other states. So now we have an entire menu of ways to modify or change a trust. We have decanting, which is obviously a play on wine, but there the trustee, using their discretionary authority, distributes assets to a new trust. We can also modify by consent now. The settlor's consent is required if they're alive. If they're not alive, all of the beneficiaries can modify via consent. Now you have to go to court, but there's a very low, it's kind of a rubber stamp court proceeding. We have non-judicial settlement agreements where the different parties can just enter into an agreement outside of court to potentially modify the trust document. And then we have old-fashioned judicial modification, where you go petition the court to say, the settlor didn't anticipate these circumstances, whatnot. That's been liberalized too. And then on top of all that, we have virtual representation, which is the idea that if you've got a set of kids that are beneficiaries and the oldest ones are adults and the younger ones are minor, the older ones can represent the minor. And then there are a whole lot of variations on that. So the point of that was not for y'all, was somewhat to confuse you, to make the point that there is lots of flexibility, but it is complicated now. And the first point is that old answers may not be good answers. If you've got a client that has this trust that had these very antiquated, very restrictive terms that everybody's been frustrated with for years, and 2 years ago, they went to see some attorney and the attorney said, we can't do anything about the terms of this trust, well, that answer may not be good anymore. It's time to go back and spend some billable hours and see if with all these new tools, if we could change the trust. Some examples that where it might be okay to change the trust, depending on all the facts, are one, to encourage total return investing. Right? Like we've got a lot of these ancient trusts that are income only. And so we write all these covered calls to produce all this income to try to get the income beneficiaries more. You may be able to go in and fix that so you can do less of that and focus more on true total return investing. If you're trying to do private equity or something in the trustee's skittish, there's a potential to add some language to the trust that would, deal with liability and that sort of thing to help encourage that. And then a lot of what's going on is adding these powers of appointment to suck assets back into estates to get stepped up basis. And as I said just a minute ago, it's now the trade-off for flexibility is complexity. So this is something that if you've got a client, they need to go to a sophisticated trust and estates attorney to get this advice. And I think the other thing, and I've heard this anecdotally that people are running into, is corporate trustees are going to have to catch up with this a little bit in terms of their compliance and distribution committees to get comfortable with the new flexibility. The other thing that y'all should know about is directed trust. I was on the committees that drafted all this, and I did a lot of the work, not because I'm smart or my colleagues respect me, because I don't have to bill hours. And I'm the only person on the committee that doesn't bill hours, so they like to give me work. I get emailed a lot about decanting and modification, et cetera, et cetera. I have not yet received the first email about directed trust, just from other attorneys asking questions. And I think that's because the attorneys are still trying to digest modification and decanting and flexibility and deal with this backlog of old trust. But focus on directed trust is coming at some point. And we've had this to a small extent in Georgia law, but we now have it in a very robust way. So how this works is a trust director has the power to direct the directed trustee. You can do this on distributions or lots of different things, but for y'all, it's normally going to take the form of investments. You have an investment advisor that's the trust director, and that director tells the corporate trustee or the individual trustee how to invest, what to buy, what to sell. And that's the arrangement. The intent of the law was to encourage more corporate fiduciaries to accept this arrangement and then to encourage the investment advice to actually be followed, to make the corporate trustee comfortable investing in that direct investment or whatever, other sort of esoteric's not the right word, but maybe more aggressive investment. So the main thrust of the statute is that a directed trustee, the corporate trustee, is not liable for following direction absent willful misconduct. And willful misconduct is intended to be like the lowest standard there is, just about. Willful misconduct to me is you come to us as corporate trustee and you're like, hey, will you wire all the clients' money to my Bahamian bank account? And then we do it. Like, that's willful misconduct. But, if you tell us to invest in cattle futures and we do it and we lose all the clients' money, that's not willful misconduct. So that's clarity that we follow direction and we're not going to question the investment advisor's judgment. The second part of that is that the investment advisor, the trust director, is a fiduciary. And that is mandatory, can't be waived, can't be altered. The thinking behind that, and this is a little bit of a stretch for an example, but the thinking behind it is, every trust has fiduciary duty attached to it. And assume that, there are 10 units of fiduciary duty, and 3 of those units are investment units, and 7 are distribution and other units. Well, if the corporate trustee is not liable for the investments, if you take those 3 units of fiduciary investment off of the corporate trustee, they can't just disappear. Right? The law is saying that we can't have a lower fiduciary standard in these directed trusts. That fiduciary responsibility has to go somewhere. And the only place for it to go is to the trust director, to the investment person. So I'm going to be very curious to see how the investment community responds to this. Because on one hand, it's this very robust set of rules that helps y'all manage money that's in trust. On the other hand, you have to be a fiduciary. Now, I haven't followed it closely, but I know there's been lots of discussion and back and forth about the fiduciary duty in the investment world outside of the trust world. So it'll be interesting to see how this plays out in Georgia. The takeaways for y'all is that this opportunity, it's here now, and it's something that I think all of your institutions ought to be talking about and being aware of and thinking about what you're going to do. So now that transfer tax is less of an issue and less time and energy is being devoted to it, more time and energy is going to things like asset protection. And I think beyond sort of family dynamics and some of those softer issues, asset protection and income tax planning are the big areas of emphasis right now in wealth transfer planning. So asset protection, and what we're talking about here, is not the use of LLCs, which is important, but I'm going to talk about trust. And when the assets are in trust, as a general matter, they have creditor protection. So the first thing to do is to leave them in trust. When we're creating trust for kids, we don't want to mandate distributions at age 35 and 40. And the estate planning community is becoming better and better at this. You can have some non-binding language that says, trustee, unless there's a really good reason not to, I'd like you to distribute the principal at 35, 40, 45. But that kid may get there and they may say, you know what, I'm a doctor or I'm an entrepreneur and I really like this creditor protection. I don't, you please keep it in trust. Or they may see, my marriage is not going very well. I don't want this money right now. I may need to be next door hearing about the economics of divorce. And if this money's in trust, it's much more off the table. So the first thing to do is to leave it in there. And it's best if that trust where it is has multiple beneficiaries. And that can be the kid and grandkids. And then you don't want any sort of fixed distributions. You want discretionary. That's for the estate planning attorney to worry about. The lesson there is leave it in trust. And then we don't have the issue of how to get it back in trust. So, and I'm going to skip ahead to the top part of this slide. When assets are in trust, if it's a third-party trust, and I'll use a wife. So the wife puts assets in trust for other people, for the husband, for the kids. That trust has creditor protection. In Georgia and all the surrounding states except Tennessee, if the wife puts assets in trust for herself, she doesn't have creditor protection. Right? Everybody can kind of see the logic there. Like I can't just go put all the assets in trust and then tell my creditors, ha-ha. So that's the policy, and we'll come back to when it's not the policy. But so what lifetime Q-tips do, and Q-tips are just a kind of marital trust. They're a trust for the surviving spouse. And this is in Georgia law now as of July 2018. And what the wife can do is she can put the assets in trust for the husband. The husband gets all the income, potentially gets principal distributions. The idea there is the wife didn't truly part with the money because the husband just gets the money and uses it to pay the joint mortgage and to go on vacation and to pay all the joint expenses. So the wife didn't really give up anything in terms of economic value, but she did part with the assets. And they're in a trust, so we have creditor protection. If the husband predeceases the wife, the trust can stipulate that the wife becomes the beneficiary. And it's not a self-settled trust. Even though the wife put the money in and the wife is now a beneficiary, the fact that it was a marital trust to the husband in the middle means you still have creditor protection. There's some weird transfer tax rules that this mirrors, and that's how it was sold to the General Assembly. It takes a while to understand why it makes sense to do this, but it does. And so this is there now. And we know this works. These self-settled asset protection trusts I'm going to talk about next may or may not work in Georgia. But this works. It's in the code. So if clients are worried about creditor protection and they've been married for 40 years, and nobody's worried about divorce, then lifetime Q-tips are a surefire way to go. Tennessee and a lot of other states that don't have a state income tax, they view their lack of a state income tax like Texas views oil. It is a natural resource to be exploited for the state's economic benefit. And they pass very robust, very progressive, or aggressive trust law, depending on your point of view, to try to attract trust business to the state. And Tennessee is one of those states. And in Tennessee, if you meet some fairly basic parameters, you can put assets in trust for yourself and have creditor protection. Now, you still have the Uniform Voidable Transfers Act. So, you can't put them in trust after someone's already filed a lawsuit against you. You still have voidable transfers issues. But if you're just a developer or a doctor and you're worried about liability but don't have any specific creditors on the horizon, you can go to Tennessee and form one of these things. And you can put assets in trust, and you're a beneficiary, and your family's a beneficiary, and there's creditor protection. The issue for people in Georgia is whether a Superior Court judge is going to care what Tennessee law says. Because if Tennessee law is against public policy in Georgia, then Georgia doesn't have to enforce it, even though the assets are in Tennessee. My bet is that under the right fact scenarios, a Superior Court judge is going to find that this is against Georgia public policy, and they're going to attach to the assets. That is especially true if the assets are Georgia real estate. If they're stocks and bonds and they're in Tennessee, I mean, technically, Georgia can't go to Tennessee and make Tennessee give Georgia the stocks and bonds. But you know, the Superior Court judge, I think, to the extent they can, is going to ignore this. I don't think it's a bad thing to do necessarily. I just think the thing to understand is it's not bulletproof. And clients that do this need to understand that it's not bulletproof. So individual income tax. You know, the 2017 Tax Act, as all of y'all found out April 15th, even if you extended, you had to pay estimates. It is very fact sensitive as to whether your tax liability went up or down. So we're not going to spend a lot of time on that. What I want to talk about that's income tax related subjects are these. And we'll just get right into them. The SALT limitation, and we'll see how many of them we can get through. So the SALT limitation, state and local tax. You know, you can't deduct more than $10,000 of state and local tax on your return. And the policy justification for this was we shouldn't subsidize these, you know, states, especially these high tax states. And that's a little problematic because states like New York and New Jersey and California put vastly more into the federal coffers than they ever take back out. Those states are helping less economically successful states. There's a transfer of money through the federal government. So that's kind of not a very valid point. And also, I mean, what about muni bonds? Like, we don't want to subsidize states, but we're happy to keep subsidizing municipalities. And then there's the double taxation. You know, when you can't deduct your state tax, it effectively is double taxation, which has been the rallying cry against the estate tax for a long time. So it's not the cleanest from a policy standpoint, and a lot of people think it was a politically motivated, just kind of the Republicans giving the finger to New Jersey and California and New York. I obviously don't know, but that's just a little bit of background on that policy. The response to it has been very interesting, and it does impact Georgia, which I'll get to in just a second. So states and municipalities, they don't like this, right? I mean, New York doesn't like it. So what New York has done is they've tried to transform the state tax into a charitable deduction, because the charitable deduction isn't limited to $10,000. Now that's caused some collateral damage in Georgia, which we'll get to. They've also done some things with payroll and pass-through, but that's been much less common, and we won't get into that. Individuals, you know, it's increased the incentive to go to Tennessee or Florida and avoid income tax. But also there's some things you can do with trust to avoid this limitation. Probably the most interesting piece of this and what we'll spend time on is these states trying to turn this state tax into a charitable deduction. So here's how it works. The government sets up a charity that it controls. It's a charity to build roads or, you know, whatever it does. The taxpayer makes a gift to the charity and then gets back a tax credit. And the tax credit is how it pays state income tax. It's like film credits. You pay with a credit. And a lot of times you only get a 90 cents on the dollar because the idea that you lose 10 cents is supposed to like give it economic substance or something. But the important point is the taxpayer gives a gift to this government-controlled charity and gets back a tax credit. So when you go to pay state tax, you say, here, Georgia, or here, New York, here are my credits. When you go to fill out your federal return, you have a contribution to a charity, which is not subject to the $10,000 cap. So you deduct the full amount of your state tax. That sounds ridiculous, right? I mean, like, you're like, how can the states do that with a straight face? Well, the thing about it is states have been doing it for forever, Georgia included. You know, there's this program that you can give money to a private school to fund scholarships. Tax credit on the state, charitable deduction on federal. Our rural hospital credit, state tax deduction, you get a credit on your state return, you get a charitable deduction on your federal. And the IRS said, you've been screwing us a little bit for a long time, but now you're really screwing us, and we're going to put a stop to it. So they issued these regulations that say for every dollar you get of state tax credit, your charitable deduction is reduced. So basically, you don't get a charitable deduction for giving to these government-controlled charities, which sort of blows the whole thing up. Well, like within a week of these proposed regulations, New York sued, New Jersey sued, California sued. And so these proposed regulations, who knows when we'll ever have a final answer. What the difference it really makes for us and our Southeastern clients is we had a number of clients back off of those rural hospital tax credits. I think they're pretty low risk. I think when I get on the connector to go home this afternoon, I'm going to drive 10 over, and I'm going to count on people driving 15 and 20 over, getting pulled over before I get pulled over. So I think that if you're doing this in Georgia for you're giving $5,000 to your private school to fund a scholarship, I don't think the IRS is coming after you. I think they're going to be busy in New Jersey, in New York, and wherever else. The bigger you are and the more public of a figure you are, I guess the more risk there is. But that is something people are having to worry with. Sure.
The other reason to keep doing it is a couple of hospitals can actually fund it with appreciated securities. So if you have a tax account of appreciated securities, you fund it with that. Essentially, even if you don't get any federal tax deduction for it, you never have to recognize that tax on the appreciation.
Yeah, that's a very good point. So, with the charitable deduction or gift to charity, right, you can go with appreciated securities. So then it juices it even further. Yeah, I don't think there's a lot of risk there. But, that's one where the client kind of has to understand and decide what to do. And most of the people we had back off were like a CEO of a publicly traded company, where they're just really very averse to any sort of headline reputational risk. In the interest of time, I'm going to skip over this. There's some games going on with people putting houses into non-grantor trust to get around this. And what I would say on that is I'm just not sure the game's worth the candle. I think I read somewhere there are 22 different bills in Congress to either relax or repeal the $10,000 limit. So I'm hesitant to go create this trust in this huge complex sort of planning scenario on something that's likely going to, if not go away, be significantly liberalized as soon as the political pendulum swings back the other way. I do want to cover this real quick, especially because, like I said earlier, y'all are a quantitative crowd. So when you're doing back of the envelope tax calculations in Georgia, prior to this SALT limitation, I used to always use 5%. With the idea that because by the time you deduct our 6% tax on your federal return, it's effectively a 5% tax. So if the client's paying 39.6% federal, you just add 5% on for Georgia, and that's your back of the envelope tax number. Well, now that's not the case. When you can't deduct, you're paying 6%. So for a lot of our really wealthy clients, their tax liability, state tax liability just went from 5 to 6%. So you've got even more incentive to go somewhere like Tennessee or Florida and try to avoid state income tax. Now the first issue with this is a practical one. You can put all the assets in Tennessee, but if you distribute the income back to a Georgia resident, well, you hadn't done anything. Because the income came to the Georgia resident, it's going to show up on their return and be taxed in Georgia. So the first thing is you have to be able to not use the income from these assets in order for this to work. Oh, sorry, I'm on the wrong slide. Beyond that, there's the question of whether it legally works. And that is a question that was orally argued before the Supreme Court, I think Tuesday, the U.S. Supreme Court. There's this Kastner case out of North Carolina. And if you've been paying attention, even in the popular press, there's the Wayfair decision where in the South Dakota stuff about the idea of what's required in the way of minimum contacts with a state in order for the state to tax it. And this has been a big deal with Amazon and all the internet commerce. And it's now spilled over into trust. I think Georgia has a very weak case to tax a Tennessee trust solely because they're Georgia beneficiaries. As long as you don't give the Georgia beneficiaries income, I think it's very unlikely. And I think the Georgia law is very muddled. So I wouldn't be that put off from going to Tennessee or Florida. I think the more important point is this. And this is kind of another is the game worth the candle question about planning. So I'm going to assume a portfolio with 2% dividends and capital gains. Again, this is very round and rough. That capital gain, the 2%, is my dividends plus my sort of annual turnover from the account being managed. So I'm getting 2% of, recognizing 2% of income every year. I'm getting 4% of deferred growth for a 6% total return. And my federal rate is 23.8. That's the top 20% capital gains rate plus the NIT. So if I avoid 6% state income tax, it yields basically an annual benefit of 10 bips. Which, I mean, is compound interest is a magical thing, and 10 bips is meaningful. But you need to look at that benefit in comparison to the cost you're going to incur setting up this Tennessee trust and administering the Tennessee trust every year. Now, if you're setting up $1 million trust, that 10 bips may get eaten up pretty quick in trustee fees and tax returns and the like. If you're creating a $100 million Tennessee trust, then that 10 bips is a whole lot bigger, and it probably is worth it. If you're with a corporate trustee who has Tennessee offices, it probably doesn't cost you anything more to move the situs from Georgia to Tennessee. So it's fact intensive, but before clients rush out to form their $1 million Tennessee trust with diversified portfolio that doesn't have a lot of built-in gain, you need to run some numbers to go, what benefit are we going to wring out of this thing, and is it worth the trouble? And then let me finish with opportunity zones. I think I get 6 emails a day about seminars on opportunity zones. And I don't know if y'all have the same experience, but they are so hot right now. The idea behind them is twofold. There's all this capital out there in low basis assets, and people are not selling that capital, and it's not entering our stream of commerce and finding its way to its most productive use because grandma doesn't want to sell the Coke stock because grandma's going to die and get a stepped-up basis. She doesn't want to pay the income tax. And there's this, coupled with that is this idea that we want to incentivize investment in lower income areas, opportunity zones. So the proposition is, hey, if they sell their low basis Coke or other low basis asset and then reinvest those proceeds in an opportunity zone, we'll let them defer the income, like a 1031 exchange kind of. Except they made it a lot more complicated than that. They said you get a 10% basis increase in year 5 and a 5% basis increase in year 7. So what that means is that when you avoid 15% of the gain on the sale of your asset. But in year 8, you have to pay the tax you deferred. You have to pay the 85% of gain. But as you'll see in that last bullet point, you've got to hold it to year 10 to wring all the tax benefit out of this thing. So if you sell $1 million of zero basis Coke with a capital gain rate of 28, you owe about $250,000. The $1 million of sales proceeds is still in the opportunity zone because you're trying to get to year 10. So you've got to come out of pocket from somewhere else to pay $250,000 of tax because you can't use the sales proceeds because they're still in the opportunity zone. And then if you make it to year 10 in the opportunity zone, your change in value from year 1 to year 10 goes away. You still pay the gain on the $1 million sale. You pay 85% of it. But if you invest the $1 million in year 1 and year 10, it's $1.6 million, you don't have to pay tax on that $600,000 of increase in value. Now you have to qualify, and there's a lot that goes into whether or not you qualify as an opportunity zone investment. I've run some basic numbers. If you assume you capture all the potential tax benefits, you stay in until year 10, as best I can tell, a regular non-opportunity zone investment that returns 7.5% is equal to an opportunity zone investment that returns 5%. So this gets you 2.5% of return a year, which is a big deal. But you have to consider a lot of the negatives. First of all, this is private equity. So they're going to be big sporting managers fees that may do a pretty good job of eating up that 2.5% of gain. I think the opportunity zone property is going to get really bid up. Everybody is starting these funds. Everybody's raising money. There's a limited supply of opportunity zone property. And y'all, it's basic supply and demand. You have all these managers that have raised all this money, and they got to put it in opportunity zones, and you have a limited supply of opportunity zones. And I think there's a potential for lots of people to overpay. There's also a 10-year lockup. I mean, that's a long time for a real estate investment, at least according to what my colleagues that know anything about investments tell me. And then finally, you just have a lot of other uncertainties. I mean, we still don't have final regulations on some of this stuff. I'm not at all against opportunity zones. I'm against them turning from advice into a product. If Granny's got $1 million of low basis coke, I don't think Granny should sell it and invest in opportunity zones solely to capture the tax benefits. I think people that have some real estate experience, I think people that have businesses that are looking to open new factories or new warehouses or develop hotels, absolutely consider opportunity zones, but I don't think they're muni bonds, right? Like we don't sit around and go, you know what, we'd really like to support municipalities. Let's go buy muni bonds. You buy muni bonds solely for the tax benefit. And I don't think opportunity zones are muni bonds. I don't think they're worth going into solely for the tax benefit. I think you need some more sort of organic motivation there. Chuck, yeah, sure.
Am I accurate that in the case of Granny, she also misses the step up if she dies in this insurance?
I think that's right. Yeah, and I'll be honest with you. I mean, I've sat through a lot of these seminars. There are now people that are spending, 100% of their time dealing with opportunity zones. And it's one where we've got a few clients that are really pursuing them, but they're pursuing them within businesses. And we've basically said, look, let's get you set up with, counsel that's really specializing in these. Because and I think that is probably one of the best takeaways from this is if you have a client going into one of these things, I would say, look, your fraternity brother that's been your corporate attorney for the past 20 years may be a great guy, but you want to go get somebody, not even me. I mean, I'm an estate planner here. You want to go get somebody that is truly specializing in these things before you really do anything beyond just invest in a sort of a mutual fund, hedge fund type of way. Chuck, how are we on time? Or?
As long as you want to go, but they're going to start something here in about 5 minutes.
Okay, no, that's good. I mean, I was going to. You know what? I'll tell you. I think y'all ought to know. Let me tell you about syndicated conservation easements really quick. I apologize for taking up your break, but this is a national issue that Georgia is kind of at the epicenter of, which makes it interesting. So non-syndicated conservation easements work like this. The owner of property, somebody owns a farm, a cattle plantation, hunting plantation, they transfer this bundle of rights to the land trust. And it's the right to develop or subdivide, in the terms forever. And the owner continues to own the property, and they've retained the right to harvest timber, to graze cattle, to hunt and fish. So they can keep doing all that stuff. And you get a charitable deduction for the differential in value. You say, before, when I had the right to sublet it and develop it and mine it, it was worth X. Now that I've given up those rights, it's worth Y. And X minus Y is a charitable deduction that I take on my income tax return. So it's good stuff. We're preserving property, preserving green space, etc. So then we have syndicated conservation easements. And here's how those work. The promoter goes out and finds somebody in South Georgia that's got timber property or property just sitting there, and they find this property that also has kaolin or aggregate or some sort of mining potential. It's what most promoters are doing is mining potential. And then they go create this entire business plan with appraisals. They go drill, they do all this stuff to create all this plan that they're never intending to execute. And then they go, hey, you know what? This property I bought for $10 million, well, it turns out it's worth $100 million because look, I can mine it. And so in the course of all this, they create a conservation easement and then they sell it. They go, well, look, I have this business plan. I could mine it. It's worth 100, but I'm going to do a conservation easement, and now it's worth only 5. So I have like a $95 million, and I'm making up numbers, $95 million charitable deduction. And then they go out and they sell it through an LLC. So the investor, the taxpayer, puts in $1, and they get back like $4, $5, $6 or more of deduction, even though they parted with $1, but now it's like a $6 charitable deduction. The IRS thinks that's BS. And it's a listed transaction, which means that you have to say, hey, IRS, this tax return contains something that's going to piss you off. And so you have to notify them that you're doing this. And you have to notify them when you're receiving more than $2.50 of deduction for every dollar of deduction. I'm not going to go through the math, but when you do it, you realize $2.5 of deduction per dollar of investment is where it starts to make sense. So basically, all of these are listed transactions. They are very widespread in Georgia. We recently signed a new client. One of the sons is a tax partner at KPMG in New York. He had no idea about these things. And he went and talked to his colleagues, and they were all just like, oh my God, like people do this? But down here, because of the unique sort of geological that you can find these pieces of property, there's a lot of it. The Justice Department just issued, I think, what amounts to a cease and desist order against an Atlanta firm that was a syndicated conservation easement firm. There's bipartisan congressional scrutiny. I think this is like one of the 6 things Republicans and Democrats can agree on, is that these things are abusive. And so now they are forming a committee to study the abuse. And a lot of land trusts refuse to receive them. They're like, we're not going to play this game. We don't want the bundle of rights. Now, I hope if anybody in the room is a big fan of these, I didn't mean to offend you. They are something that you need to go into with your eyes very, very, very wide open. And I've heard some of the more responsible promoters say, look, if you're buying 500,000 of these things and losing that 500,000 will be catastrophic for you, then you shouldn't buy them. Like, there's a lot of risk involved in these things. And you can go find people walk up and down Peachtree that have bought these things and never gotten audited. But I do think the clock is sort of ticking on them. And with that, I know, Chuck, we'll wrap up. I appreciate y'all having me. I hope this was useful. One last question.
Let's say a client gives stock to a daughter, and the daughter at death gets the stepped-up value. Let's say the daughter does not sell the stock and gives it to her son, the grandson. Does the grandson get the stepped-up value?
Yes, once it's stepped up, it's stepped up. You don't lose the step up. So yeah, if daughter dies,
There could be 2 step-ups.
oh yeah, there can be, you can, every time somebody dies, there's a step up. Yeah, and you do get some of these sort of deathbed transfers, and there's actually a section in there that deals with, wife's really sick, so we transfer all the appreciated stock into her name, and she dies, and then husband gets it back. There's some code that prevents people from playing this game of, finding sick people to die with their assets. But if as long as it's family, you can, child dies, step up, grandchild dies, step up, great-grandchild dies, step up. It keeps going. Yeah, and then I know we got to go. I'm around for a little bit if anybody wants to ask any more questions. I appreciate everybody's time. Thank you.